welcome everybody. Thanks for coming along. And once again, I'm sorry for those of you who did reserve a place last week and I didn't manage to send an invite and the link through to you till this morning. That was because my spam folder was playing up. So apologies for that. But let's kick off now. We're going to start off with Dan. Dan's going to look at the latest from his analysis of the 22-23 accounts. Some really interesting stuff there, kind of ahead of what anyone else is doing really in terms of looking at the financial health of local authorities. Then I'll do a section on MTFP and looking particularly at some of the business rate consultation stuff that we're expecting later in the week, and then just picking up some of the things that have happened over the last couple of months where we've not had a webinar, just picking those sorts of things up, and then finally looking at financial health and local government, the spate of section 114s, and trying to unpick what's going on there and what that means more widely for financial health in local government. As usual, we're recording this webinar, and I'll try and get it on the website by tomorrow morning if I can. But I'll do my best to do that. So we'll do the slides will take from 10 till 11, and then 11 till 11:30 we'll have a chance for chats and questions and discussion. So before over to you, Dan.
Thanks, Adrian, and morning everybody. Hope everybody can hear me okay. So as Adrian said, I want to focus on from our accounts models 22-23, but today I want to focus specifically on the balance sheet. This is a sort of an analysis that we've done more lately to supplement some of the work we do, and increasingly because we're talking about section 114s later on, I think we look out for signs and we look for the obvious ones, usable reserves being the obvious one, and the government now seems to think debt is, I've said before and I'll say it again, I think they're a little bit one-eyed on that, in that they assume that all high debt is bad, but I don't think all high debt is necessarily bad, and actually there's a more nuanced argument to have around that, which we'll talk a little bit about. I don't know if many of you have been subject to the or have filled in the consultation that was due last week on the capital risk mitigation factors. But again, when I looked at those, I thought it's a step forward, but it's not a leap forward. And again, we'll talk a little bit about that. Oh, sorry, can you move on, Adrian? Can you move the slide on?
Yeah.
So what I want to talk through today, and those of you who are members of the LGA benchmarking service, I'll be sending out a separate invitation to go through this over the next couple of weeks. But what we've done is we've looked now at everybody's balance sheet, or everybody who has released their accounts for 22-23, and we're now up to 118 upper tiers, so getting on for 75, 3/4 of upper tier authorities have now released their accounts. Pretty much all of those that had accounts for 21-22 have published them in 22-23. There's a few that still haven't. Those that hadn't published them for 21-22 just look like they're stuck forever with accounts 2, 3, 4 years out of date. We'll look at those, but I also had a look very specifically at the accounts of Croydon and Slough and Northamptonshire. Croydon and Slough have, since issuing their accounts, since there's been a lot more focus on them, have republished accounts quite recently for their latest years, which for Croydon I think is 2021, for Slough it's 1920. And I'd captured their data before, and I've overwritten that now, but crikey, is it different, massively different. And I suppose that's the first thing I'd say, is that it's something really important about getting the accounts right. And maybe the fact that they weren't necessarily as right as they might have been at those authorities might have hidden some of the issues that they had. You look at the accounts that are now being published, they're very, very different to the ones that were published before, and actually show them in a lot more financial stress than even the accounts that were published before. So looking at those figures now gives us a real insight into what we think on the balance sheet would be useful as a flag, as a measure that might indicate that there's financial stress on that balance sheet and for that authority. But as I said, it's not as the government think. It's not a simple, one or two measures. It's probably a much wider basket of measures. And it doesn't follow that if one of those measures looks bad, that the stress, there might be context around it, there might be mitigating circumstances. So what I've tried to do is look for a whole basket, but also then try to combine, interrelate some of those measures to make more sense of them. So all the analysis that you're about to see comes from the balance sheet. And those of you who are members, you'll get this issued to you in a bit, where you're able to see where you sit on these analysis and where your benchmarks sit as well, to be able to compare yourself. And I think I think there is more to a lot of the analysis, both revenue and capital, and those things that we commonly look at. So for instance, show a little bit about dedicated school grant deficits, which are really starting to overwhelm some authorities' resources, and the impact that has. So it's not as simple as just looking at usable revenue reserves in revenue. It's not as simple as just looking at borrowing for capital. And that, I suppose, that takes me to the government. What I said about the government is they've released 4 indicators, and again, they are, two of them I think are reasonably decent measures, but actually there's some contradiction within those measures. The MRP one, for instance, if your MRP is high, it makes you look more risky, but what if you're giving yourself an MRP holiday when you should be charging MRP? I don't think that indicator necessarily is the best, unless you look at the context around it. But that's what we'll try and do a little bit of today. Oh, if you move on, Adrian, please. That's an online. All of it we're doing today is a little bit of a summary session, really, but we're going to do a much fuller session that anybody can come to on the 10th of October. LGI members, you're very welcome to come to that, but we will do a separate member-only session before that and send details about that later today. But we'll really get into some detail of the balance sheet today. I'm just going to summarise a few things from what will be a much more detailed session on the 10th. If you want to move on, Adrian. So I'm going to start with the obvious, and that's usable revenue reserves. That's, I guess it's the thing, isn't it, that when an authority declares Section 114, it's unable to balance its budget, and in order to balance the budget when there's a deficit, we use reserves to bridge that gap, and at the point that those reserves are exhausted, then we're unable to use them and we're unable to agree a balanced budget. So usable revenue reserves is a decent indicator, I think, of financial stress, but it's a lagging indicator in as much as it's the consequence, it's the product, the result of decisions and the consequences of those decisions that have been made. So it kind of, we see it after the fact. We don't see it at the point that we're making the decisions. So it is a good measure of authorities in stress, and the 114 authorities all run out of reserves effectively. And therefore it has to be in any basket of measures, because it is possibly the main measure, albeit a lagging measure. We make decisions, and the consequence of that is what happens to our reserves. And what you'll see in all these graphs now is the upper tier average more lately from the balance sheet. This is taken from the last 4 years of the 100. In this case, 118 upper tier authorities that have published their accounts. But I've then gone backwards to the 3 initial 114 authorities to see if there's any patterns there. So, and I've done that with all these analysis. So what you see at the moment is reserves amongst upper tier authorities are reasonably healthy. but they are dipping in 22-23. But for the authorities, Section 114, without exception, what you see is a low level of reserves and a year-on-year depletion. Northamptonshire's jumped back. Northamptonshire haven't reissued accounts. I'm not sure whether or not their reserves were as plentiful as their last draft account said. I don't know, but actually the point at which they issued the 114 was the point at which they'd pretty much run out of reserves. So that, you know, it's a decent measure, but it's not all that's on the balance sheet with respect to revenue and with respect to resources. If we move on, Adrian, what I'm saying is it's not just about usable revenue, general fund usable revenue reserves, is it? Because some of us have HRAs. If you're at the upper tier, you have schools balances, and you also have the various adjustment accounts sitting on usable reserves. Tend to be happy that they balance and we get our accounts out, tend less to look at what they actually mean, and until you start to look at things like the dedicated schools grants deficit, which for some authorities are really, really big now. But what I've done here is I've taken all of the things that effectively are on the balance sheet that are not capital, they're revenue. I should say we kind of ignore pensions for now. Maybe we do that at our peril, because pensions are a bit funny all of a sudden, aren't they? But this is just the revenue items on the balance sheet. And if I take Croydon as an example, yes, it had very low levels of usable revenue reserves, but it also had an increasing dedicated schools grant deficit. Now, this was in the day before you had a deficit account, but it sat there as a negative earmark reserve. It's effectively taking resources from the authorities, and so it's squeezing the resources that are available. But it also had a really negative financial instruments adjustment account balance. So in effect, it had very little revenue on the balance sheet. If you'd stripped down its balance sheet, just revenue, it virtually had nothing. So the only thing it had that was more plentiful was actually HRA reserves. And when I look at that across, when I take that, again, no coincidence that the 3114s, all of their revenue items were low and reducing. But when I look at that in 22-23, you can really start to see pressures ramping up in the sector. Now, this is upper tier, so we have a separate district analysis, which I'll go through on the 10th. But for upper tier, district authorities, not all, but generally the reserves are still going up, and I put that down to probably the rates retention still in the system for districts, not for all, but for many. But what you see in 22-23 at the upper tier particularly is reserves now are reducing, and they're reducing at quite an alarming rate across some, not all, but across some. But also HRA, and this is the same for districts as well, and schools balances tend to be reducing. So resources are reducing significantly. DSG deficits are starting to increase, and again, for some, increase significantly. So this is all a reducing revenue item balance sheet that's actually pushing these authorities closer to the edge. Now, that, you know, the reduction in the available resources is one thing, but as I'll talk about in a bit, there's also a thing that I'm starting to see, whereby because available resources are reducing, be they general fund or HRA or whatever, or other things like the dedicated schools grant is removing those resources from us. We're also at the same time seeing a reduction in internal borrowing at those authorities that have reduced resources. And when your internal borrowing reduces, all other things being equal, you're at the whim of the market in terms of externalizing that borrowing. And what we're seeing, because in our capital model now we capture interest paid but also interest receivable, we see those authorities that have reducing revenue balances are now starting to have to pay more in interest because they're externalizing debt, because they haven't got the revenue resources to internally borrow. Not only that, is they're not able to benefit from the interest rate rises in terms of TM, and you really start to see a twin track system here, where those that are really struggling are struggling in treasury management as well, whereas those that are still quite plentiful are really reaping the rewards of continuing their internal borrowing, but also any spare cash are able to get 5, 6, 7%, whereas 2 years ago they're barely able to get anything. So that's starting to feed through as well when I look at the balance sheet and how it then moves on to other things. If we move on to one though, Adrian. So that's revenue. I guess my point on revenue, it's not just about usable revenue reserves, although that is a big part of it. There are other balances on the balance sheet, revenue type balances that might be getting squeezed at the authorities, and certainly seem to be in 22, 23 at the majority of authorities. But if I just go onto the whole balance sheet now, I tested a few things. I tested net assets at the bottom, but I left pensions in to start with, and the pensions are all over the place, aren't they? So everybody's had something like a 90% reduction in the pension liability that sits off the balance sheet. Now, that probably warrants a look at some point, but for now, I've removed pensions. So I've the net assets, which is at the bottom of your balance sheet, I've taken away from that, whatever your pensions balance is. That therefore, I think leaves you with your revenue and your capital items on the balance sheet, pensions put to one side for a moment. And again, that net assets, which I don't know, I was responsible for a number of accounts over a number of years, and I did the balance sheet. Did I look at it? Not really. Did I look at the net assets at the bottom of the balance sheet? Not really. Did I last year? Probably not so much. But now, having mapped that through, it does appear to have a correlation with financial stress, and I suppose that's obvious, isn't it? If you pack in and you divvy up and see what your net assets are worth, if you're in trouble, you're going to have less than if you're not. So, again, going back to Croydon, to Slough, to Northamptonshire, in each of those cases, you see a reduction in net assets. So slowly but surely, net assets as a proportion of spending power are reducing and reducing. And what you see in the upper tier as a whole is they're pretty much flat. So one might expect them to deviate a little bit, with pensions taken out less so. But if you start to see your net assets year on year declining, then to me that's a sign that there might be some financial stress. And therefore, although it's a very high level indicator, I think looking at those authorities that have failed, it is nonetheless a good indicator. So lower and or depleting net assets, I think, is a sound measure for a potential for there to be a problem. And at that point, I think it's important to jump in and see why that might be. So if we move on one, getting into capital now. So again, government consultation now has, this is effectively one of the government's new, they use total service expenditure, not CSP, although they have said CSP is an alternative. So the CFR over CSP, undoubtedly a sound indicator, because if your need to borrow is going up and it's going up, year after year after year, then that might be a problem. It's not necessarily a problem, but it might be. When I say not necessarily, it's not necessarily a problem if you're able, if you're doing lots of borrowing and lots of good capital, but the capital's is covered off, the financing costs are covered off by returns or whatever it might be, or you're making adequate MOP. It's not necessarily a bad indicator, and I think the government narrative is it is necessarily a bad indicator. It's a flag, and it's something that you might want to provide more context for, but it is nonetheless a sound indicator. And as we can see from the struggling authorities, the 114s, it's no surprise that the CFR was racing ahead in all of those, but at the same time that their reserves were coming down. Taken together, those aren't particularly good indicators. We move on one, Adrian. But this is where I think the government misses something out. So I've always, in the capital work I do, preferred debt gearing, because actually it brings it some context. It brings the context of the asset values that you have, and it brings the context of the equity in those asset values. And I just plugged this one in just out of interest and was really surprised to see it. Well, I'm not surprised, but it's quite marked, isn't it? The capital adjustment account, which I think effectively says a reducing capital adjustment account, says that your assets are depleting at a rate that is faster than that rate at which you're funding them. So if you're effectively allowing, for whatever reasons, your assets to deplete, and you're not funding that, you're moving towards negative equity. So it's not only about borrowing, it's about the assets that you have becoming worth less to you. And actually, when you look at the three authorities, that the early 114s, they've all got depleting CAA. So to me, that's worth looking at. Again, you have to put some context about why that is. It could be that you've got poor asset management and things are presetting or impairing quickly. Could be that you just had to get rid of a load of academies, so you've got the debt and you haven't got the asset anymore. Or it could be that you're not making adequate MRP provision. MRP is part of the funding. If you're not doing that, then actually your adjustment account, all other things being equal, will not go up when others are. So for me, that's that would be my basket of measures. And I think if you have a rapidly reducing CAA, it's something I'd be worried about. If you move on, Adrian. And then debt gearing for me is preferable. And again, you can see that the 114 authorities all had debt gearing going a certain way, but the upper tier average is pretty steady. So if your debt gearing is going up and you can't explain that, and you can't show that you're covering off the financing element of that debt gearing arising, that need to borrow going up and up and up, then I'd suggest you're in trouble. And that's where I say here that even more work needs to be done on this, because I know of authorities, I work with some authorities that have got high debt gearing because they've invested in stuff. Some of it is for return, which the government really doesn't like. Some of it is just good quality of life stuff, public realm, etc., housing, regeneration. And I think what the government needs to do is find something that shows that actually for those, it's not automatically a bad thing, but it is bad if there is no plan to be able to cover off the debt financing costs. And they don't seem interested in that, the government. They just seem interested in highlighting those with high CFRs, high debt, without looking for some context. And that, I know they've got into problems. Some authorities have got any problems because they're HRA authorities, particularly districts, and it looks like they're high debt. Well, that debt's covered off for the HRA with a 30-year plan. So this is where I think the government's still a little bit off in this area. But if we move on, so where in time? I said earlier about internal borrowing. So when you resources, this looks at the current resources, ignores all resources, sorry, including capital, usable capital receipts and capital grants been applied. But again, what I was saying earlier is if those resources dwindle and dwindle and dwindle, you're going to be exposed to externalising your borrowing that was previously internalised. You're going to be exposed to whatever the rates are of the day. And that, I think, again, you can see for the struggling authorities, one of their measures was their resources were just cratering. And therefore, I think Slough particularly, Thurrock definitely is now at the whim of much higher interest rates, and it has to service those, and it hasn't got any reserves to do so. If we move on one. So when I look at that, last year I did an analysis that put reserves and debt gearing on the same axis, or the same set of axes. And what I was able to show there is Croydon and Slough, you could tell they were in trouble because their gearing was going up and their reserves were coming down. But when you look at some of the others that are in the news, the Warringtons, the Spelthorns, yes, they've got very high debt gearing, but they've got increasing reserves as well. So they're the ones that the government needs to do a little bit more to actually work out the context as to why the debt gearing's high, because actually they're doing okay with it. I'm not saying that they haven't got risk, they have, and they should look into those risks. But I don't think this automatic debt gearing is high, reserves are low works unless you start to combine. And what I did here was I just divided into the CFR current resources and looked at that over time. And again, what you can see is particularly at Slough and Croydon, Northampton before it's 114, the resources were dwindling at the same time, gearing was going up and debt was going up, and therefore that wasn't a good combination. But if you look at upper tiers, it's pretty flat for most. But if you look at some authorities and authorities that really have lost a lot of reserves of late, you can start to see some that are coming down. And I'd say that's a sign of financial stress and something that is worth looking at. If you move on one, Adrian. So in terms of conclusions, I don't think balance sheets analysis, we talk about it a lot. CIPFA put it in their FM code. but I've very rarely seen it done, and I've never done it until recently. And now that I've done it, I think there's a lot to be said here. There's a lot more to do. It's not as simple as usable reserves and high levels of debt. There's a lot more nuance to it than that, and it's a lot more combination of those factors, as that last slide show. So we're developing a basket of these that effectively says, here's a list, and some of them might be red flagged, and if they're red flagged, maybe you want to go and look at those and see if there's anything to support why it's like that, or any plans that you might have to deal with that flag being as high as it is, or as bad looking as it is, so that when government comes along with its one-eyed focus, you're able to provide context for that. But using those measures, not only the Sloughs, the Croydons, I can see a number of authorities now that are clearly that there's a lot of red flags in those measures, and I'd say those are the ones that are struggling. Sometimes when you read about them in the press, I put them through the model and think, yeah, I can see why they're threatening a 114. And I think that's an analysis that's really hit in the last year and is set to continue next year, because I can see some real sort of downward spiral type trends in some authorities, particularly some of the authorities that have released accounts much more recently in the last few weeks. Move on. I just want to say a quick word before I finish about working Thurrock in Birmingham. I've run none of them released accounts working in Thurrock, not for 2 years, Birmingham not for the last year. But I looked at their previous accounts in this model, and actually they do show up some flags. Woking Thurrock had high borrowing, for instance. Birmingham didn't. Birmingham looked reasonably healthy, other than it had this unusable reserve called the equal pay account unusable reserve, which I haven't seen anywhere else. I don't think I've seen anywhere else. And I think it was at 200 million. Well, it now looks like that is $1 billion. And that's what sunk them and put them into 114 territory. What it suggests to me, though, is as much as you look at trends, etc., there's still some nuance you have to do on top of that. So it makes me think that we've got all the items of the balance sheet, that we might need to pick out certain items and say there's a bit of validation to do around those particular items. So things like long-term debtors, long-term investments, investment properties, etc. If you've got very high level values of that, there's a bit of validation that you need to do. Say, are they still worth that? And are they still going to be worth that going forward? Because Thurrock had 861 million long-term debtor, I think it was. That's what got wrote out, or 540 million of it did. So I think there's another flag there that looks at high value items in the balance sheet and their propensity to drop in value that we need to overlay as well of these. So it's as I said, it's a number of things. It's more complex than just a couple of things, and maybe we need to flag those up. And I think that might be my last slide, Adrian. It might be that I want to remind you, and I'll put the link into the chat. We're talking about a lot more of these. I'll be looking at 22, 23 for districts, but also the other types of authorities on the 10th of October. So you're very welcome to sign up to that as and when. And I'll put that into the chat. And I think that's me for now, Adrian.
Yeah, I think you're right. Yeah, yeah. Just one last slide there, Dan. Yeah, that's brilliant. Thanks very much for that. It just provides that really in-depth context about what's happening in local government financial health. At the end, we'll try and pull some of that together with some of my stuff on forecasting as well. We know there's a lot in the press around the pressures on local authorities, but at the moment, as you'll see in the second, some of our settlements in the last few years have been particularly good, but the pressures have outstripped that. So combining that with what Dan's done on balance sheets and on accounts, I think it's really, really important. So go along to Dan's event next month and get a bit more information about what's happening more widely. In my section today, it's a bit more of a mixed bag of different things, because that's kind of where we are at the moment with on the financial planning side of things. We'll look quickly at the revaluation adjustment and what that means for planning for 24-25. There's a consultation that's due out, I think later this week, on some of the detailed bits around the business rate multiplier, etc., which we'll look at. CPI, which is now becoming the important factor in our planning for next year. A little bit about council tax premium for partially occupied or second dwellings. I've got it in there because I've had quite a few questions in the last few weeks about that, so I thought it was worth going over that. And similarly with the 3% funding guarantee, quite a few people asking about that as well, and whether that will feature again next year. Then a couple of the new grants that have come out, some questions around that too. So starting off with the 2023 revaluation, just to reiterate, we've now got what I've grandly called a dynamic version of this in the MTFP model. It's really now it's all plumbed into the to pick up the data from the 2023 22-23 NNDR3 and the final rating list. So it should now give you a full calculation of what that year 2 ongoing adjustment is, and whatever the one-off adjustment should be between the year 1 and year 2 adjustments. And just to remind ourselves that in the current year, in 23-24, we've got that initial ongoing revaluation adjustment based on the draft rating list and the 21-22 NNDR3. For next year, for 24-25, that will be updated with this new, using the same calculation, but just the latest data. So have a look at that in the model and just see what that's doing for you. It should calculate that automatically for you, but have a look at it and see how much that's moving the numbers for you. And I've had quite a lot of input from authorities commenting on the calculation that we've got in there. So I think I'm fairly confident that the calculation's working accurately now. It is blindingly complicated. it is very complicated calculation. So I mean, hats off to the officials that have put that formula together, because it's not an easy one. And thank you to everyone who's contributed to making sure the model does the right thing. It's particularly complicated for authorities with designated areas, because it does adjust for those authorities' areas in a fairly complicated way. And DLUC could go into issue a calculator alongside the provisional settlement, and I think we ought to. I think I'll get cited that before the provisional settlement on a confidential basis, but I will make sure that I've compared that calculator to what's in the settlement, to what's in our model rather, so that we're confident again that you're getting the right figures there. Now, there's one thing that has emerged in the last few weeks that I wanted to draw your attention to, which was what happens to this one-off adjustment in 23 in respect of 23-24. So, as we said, we had the draft adjustment that's applied to your top-ups and tariffs in 23-24, and then the final adjustment for 24-25 with this one-off correction that will be applied to your top-up or tariff in 24-25. As I understand it, that one-off correction in 24-25 should be accrued for 23-24. I think that's what SIPFA are advising, and I think Mark Catlow from SIPFA is on the webinar today. So I mean, we can talk about that later on. That might be quite useful to talk through the thinking on that. I think it's really just looking back to what happened in the 2017 revaluation and what happened there. So that, but it does make sense that that's how that one-off adjustment would be treated in your accounts. But I would stress though that they're not going to adjust the top-ups and tariffs themselves for 23-24. You know, the adjustment we made through the 24-25 top-ups and tariffs. However, the adjusted top-ups and tariffs will be used when calculated the levies and safety nets in 23-24. So we've got quite a complicated picture there, that the one-off adjustment does go into your 24-25 top-up and tariff. You accrue for it in your accounts in 23-24, but the adjusted top-up and tariff will be used when calculating levies and safety nets in 23-24. For most of you, that one-off adjustment is pretty small. It doesn't make that much difference. But for some people, it's a big adjustment and it makes a big difference. I've shown you here what's happening with North Somerset. So you can see there that their ongoing adjustment, the draft adjustment for them in 23-24 was 3.3 million, which took them from a small top-up to a small tariff authority. But when we look at the adjusted figures, that's swinging it back the other way. So their one-off adjustment is 1.8 million, and what we're expecting is that North Somerset will go from being a tariff authority in 23-24 to being a top-up authority in 24-25. So what we're expecting is that, you know, obviously North Somerset would have to accrue for that 1.8 million pounds one-off correction, but also that when the levy and safety net calculator comes through, that actually in 23-24 they're not treated as a tariff authority, but they're treated as a top-up authority, because that one-off adjustment will be applied in 23-24 as well when calculating levies and safety nets. So just being aware, that's North Somerset's an extreme example, and I think that, as far as I'm aware, they're the only one that, as a result of this revised revaluation calculation would go from being a tariff to a top-up authority, but it just illustrates that things can move, and that's how we're expecting them to be treated in the system this year and into next year as well. Some of you will be aware that there are some changes that DLUC are looking at for the business rate retention scheme, thanks to those who sent through papers that have been circulating around in the last week or two. Now, as we understand it, the papers that we've seen so far that were kind of circulated in August, they're kind of draft papers, and I'm expecting there to be a consultation paper issued later this week. So there were still some options in that draft paper that I don't know how they'll be handled in the consultation paper itself. So once that paper's out, we'll issue a new briefing note to go through what's actually in it, so we can comment on what the proposals are or what the consultation actually does cover. And the consultation is required because there are changes that are coming through in this non-domestic rating bill, which is currently going through Parliament. The main thing in that's going to affect the business rate retention scheme is that there'll be possible powers from 24-25 for ministers to apply different increases in multipliers for large and small businesses. So at the moment, the large and small business rate multipliers go up in lockstep in the same percentage increases. But obviously ministers want a bit more discretion about how they do that. I guess that's so that the large business rate multiplier can go up more quickly than the small one, for instance, just another lever to be able to manage the system. But clearly that does have implications for cap compensation if different elements of the multiplier are increasing at different rates, because authorities have got different splits of business rates raised on the large and small business rate multiplier. So that is a big issue, and will make create a lot of complexity if that comes through next year. Then there's a smaller one about the green plant and machinery reliefs and how that's funded. That's pretty small bit though, just about £2.3 million, I think. So nothing too big. But in all of this stuff, I think the trade-offs here are about the degree to which we have a system that accurately reflects income levels and the cost of different policy decisions, reliefs, etc., and that trade-off with simplicity. These things that are being proposed, there's a really good effort to try and make them as accurate and fair as possible, but that does come with the price of this system becoming increasingly more complicated. So I think when we look at that consultation, we'll look at it in more detail in a webinar next month. There is, just to bear in mind, there is that trade-off between accuracy and complexity. I want to look at a little bit more detail about this variable multiplier consultation. These are some quick points based on the paper that I've seen, but we won't know precisely what's being proposed until later this week. So as I said, it's about ministers having that power to increase the large and small business rate multiplier by different amounts. And what that will mean is that if those multipliers do go up in different ways, then each authority will have to have its own cap compensation fraction. So as I think probably the most likely proposal would be that that's calculated once for 24-25, and then not updated again until the next revaluation. So kind of like the small business rate adjustment, that's done once and then it's not changed again until some point in the future. So each authority has its own mix of business rate income from large and small businesses, and so will need different levels of compensation with that different fraction. So some London boroughs with lots of large businesses get 85 to 90% from large business rates. Large businesses, Cornwall as an example, only 55%. But I think that part of the problem here is that I'm not sure that DLUC are entirely sure about how much does come through each of those sources. So I think they might be asking you to provide more information through the next NNDR1 to tell them how much that split will be between large and small business rate income. So each authority will have its own individual cap compensation fraction that will be applied to all the elements within the system. So as you understand, that's business rate, funding level, and then to calculate top-ups and tariffs. So in essence, that means it's also being applied to your business rate baseline as well. Now, I do get that about applying that new cap compensation fraction to your business rate baseline and also to your business rate income. I'm not quite sure that it's the right thing to do to apply it to your baseline funding level as well. I mean, that's real resources, that's real funding that you get to retain. So having a different fraction that's applied to that BFL for each authority, I'm not quite sure that works correctly. I think that does result in different authorities having different levels of increase in funding. I'm not quite sure that that's correct. And then, as ever, designated areas causing havoc in the system. I think existing designated areas will not have any change in their cap compensation multiplier. There are already terms in place there that can't be changed, so there will be no change for those DAs. But for new DAs, they will have their own cap compensation fraction based on their mix of large and small business rate income. So in theory, the new individual compensation factors should reflect actual changes in business rates income, and officials are trying to make sure that you don't lose out from having a different way of applying that factor. I think there's some potential for some variances, gains and losses in places. Potentially things change from year to year, and I think as the paper makes clear in places that at the moment the system is possibly more generous than it ought to be, and some authorities as a result are gaining a little bit more than they ought to be. So there are some gains around the edges there. And then that last point, I just want to double check what's happening with baseline funding level and whether everyone gets the same treatment in that. But we'll have a briefing note out early next week once we've seen the consultation paper, and then we'll have a webinar next month to talk about it in a bit more detail. So moving on to CPI, Consumer Price Index. This is, as I said, the crucial figure for the 24-25 settlement. Either the business rates multiplier will increase by CPI, or local government will get cap compensation to compensate for not having had that increase in multiplier, and that will be applied on the usual basis. There was a surprise reduction in CPI in August, down to 6.7% from 6.8% the month before. Most forecasters had expected a small increase in August, so that I think what people are saying is that small reduction actually is seen as a strong sign that inflation is falling more quickly than expected. And this measure of core CPI inflation is one I think the Bank of England in particular looks at as the key indicator of where inflation is going. And that indicator fell from 6.9% in July to 6.2% in August. So that's showing that inflation, in terms of domestically generated inflation, is falling quite quickly now. So in our model, we've had for a while now a CPI forecast for September, which is where the CPI for the multiplier is pegged, of 6.0%. That possibly looks a little bit on the low side now. We might be looking at something more like 6.2, 6.3%. But we're so close now to actually getting the real figure that we'll stick with 6.0% in our model for now. The September CPI comes out on the 16th of October at 7 a.m. So I think we'll all be up nice and early to check that out, being almost the key figure now in the settlement for next year. So keep an eye out for that. And as soon as that comes out, we'll let you know, and we'll do an analysis and update our model on that basis. Then moving on to look at the second home premium. This is part of the levelling up bill, which is winding its way through Parliament, taking its time. It's not going very quickly. But the key thing for a lot of authorities is this new premium that you'll be able to levy on second homes. So it allows billing authorities to apply a 100% premium on what are called partially occupied dwellings, in other words, second homes. Now, we estimated that could be nearly 500 million if all billing authorities applied the full premium. So that's a lot of additional funding. And for some authorities, the amounts are really significant. Will all billing authorities apply the premium? I didn't know whether they would actually. I mean, it'd be interesting to find out from you whether everyone will be. I've heard from quite a lot of different types of authority that have said they're going to do so. Certainly the ones with large kind of tourist, large second home bases will do so. Places like Westmoreland and Furness, Cumberland, etc. But we've spoken to lots of others who actually intend to, in places that you wouldn't necessarily expect, parts of Greater Manchester, parts of inner London, for instance, even places that don't have that larger second home base. I guess it doesn't cost any money to do that, or very little money to do that, and it can potentially raise quite a lot of money. However, the earliest date that the premium's going to be introduced is 25-26. Billing authorities have to give council taxpayers at least 12 months notice, and I think that notice can only be given once the bill's been received royal assent. So I think you'll need to wait until that royal assent comes through before you can actually make the decision and tell council taxpayers what you're going to do. There's a good briefing note from the Hansard Society on why the current session has taken so long and why the levelling up bill is taking so much time to get through Parliament. I think it's just coming back from the Lords to the Commons for whatever the final reading is. I know Stuart Hoggins on the call. Maybe afterwards, Stuart, we can talk about whether we think that's actually going to go through in time for 25-26 as well. The definition of second home's curious as well. You might want to have a look at if you're thinking of doing this. It talks about a partially occupied dwelling. It doesn't mention second homes or primary residence or secondary residence. So it's a slightly odd definition. It might be worth understanding what that means and how that works. And also about the data on second homes as well. We're just using line 11 in the CTB1 form, but that's likely to be out of date, and also when you get down to it, subject to quite a lot of gaming and avoidance, so you may not get the income that quite you're expecting. Then there's this 3% funding guarantee. That's something that came in 23-24, and the purpose of it is to ensure that every authority has at least a 3% increase in core spending power, excluding whatever you can increase from the Band D. So it's just looking at tax-based growth and increase in grant funding from central government. And it kind of replaced the lower tier services grant, which had an element within it that ensured no authority had a cash terms cut in core spending power. So it's kind of doing a similar sort of thing, but it actually was more generous. And mostly it's been it was paid over to shire district councils in 23-24. So it's mostly around shire districts having lower increases in grant funding, plus largest cuts in some places in new homes bonus as well. I think only one authority, Wokingham, actually got any 3% funding guarantee, although some were quite close to it. Now, in our modelling, we've expected a similar funding flow in 24-25. And I think it will do a similar sort of thing in 24-25 as it has done this year. Now, we're working on the basis that the policy statement in December 22 talked about the core settlement being, continuing in a similar manner in 24-25. In other words, we're expecting that the key features of 23-24 will be repeated again next year, and I'm assuming that the 3% funding guarantee is part of that. And also recently, ministers have used this at least the 3% increase line when they've been talking about local government funding and the pressures on places like Birmingham, etc. You can see that quote there. Recognise all councils are facing pressure, so we're introducing a one-off funding guarantee to ensure that every council sees at least a 3% increase in CSP. So that's kind of, it does seem like that's one of the key kind of like ways ministers have got of defending themselves to make sure that they can, that they're showing people that they're funding authorities adequately at the moment. But in 24-25, in our modelling anyway, we just start to see some more upper tier authorities getting into that 3% funding guarantee next year. Places like Surrey, Richmond, upon Thames, West Berkshire, Windsor and Maidenhead, plus some combined authorities as well. Now, the reason for that is that the increase in social care grants next year are just not as big as they were this year. So those authorities, and you can see that they're typically lower need, higher tax-based authorities. They're affected by the way that we've applied equalisation in the social care grant. So you can see it's those kinds of authorities that are just starting to dip below that 3% threshold for that guarantee. Now, will ministers take alternative action? They could do. They could put through less equalisation through the social care grants, or they could just let that 3% funding guarantee roll on, or they could make some other changes around that. But for now, we're just assuming that ministers do the same thing next year as they've done this year. Then we have this new grant that came out over the summer, the Market Sustainability and Improvement Fund. The grant itself, does what it says in the tin. It's there to, you've got 2 years of funding, £365 million this year, 205 next year, all paid in one chunk. And it's basically to help authorities to invest in social care provision, particularly workforce pay, et cetera, et cetera. But the question that authorities have been asking is that, is this short-term funding, or will it go into the baseline in 25-26? All the other social care grants, we've assumed that all those grants do roll on into 25-26. But this is slightly different. The phasing's slightly odd, it going down in the second year. The purpose of it is clearly to spend on things that will still be, councils will still be spending on in 25-26. So it ought to roll on, but it's just slightly strange that the way it's phased and the way it's phrased. So I'm a little bit concerned about that. I've got a poll, and I just wanted to gauge your opinion about how you've actually dealt with this in your own medium-term financial plans next year for 25-26. Can you see that, Dan?
Yeah.
So if you want to put that in, so most of you, 78%, you're not. Oh, that's coming back. I'll wait a second. This is it's exciting. So about 70-odd%. So about 70-odd% of you are assuming that the grant does not continue into 25-26. That's about. Oh, it's moving. We'll come back to the end, but you can see that for yourself where it's going. Most of you are assuming that it doesn't continue to 25-26, which is what I've got in my model, is what I'm assuming. And I think I guess for most of you, that's just about being prudent about what happens in 25-26. A couple of other grants that have come out as well. The first one is this internal drainage board funding. Pardon me. It's only £3 million, but for those 15 Shire district councils that are going to get it, it's obviously an important amount of money and something that lots of councils have been asking for quite a while now. So it's it's compensating authorities for these drainage board levies that over which the council itself doesn't have any direct control, but which it has to fund from out of its council tax income. So that's a welcome bit of money, and I'm assuming again that is baselined from 24-25 onwards as well. And then a small amount of money, this is £40 million. Again, more funding for winter pressures from the HSC. I think it's £10 million more than last year, but it's bid-based funding, so we won't put that in our model. One last thing before we go into the section 114 stuff, just to let you know about the webinars. We'll have one towards the end of October next month. So we'll talk about the CPI, the inflation outcome in that webinar, and hopefully I'll be able to get Jeffrey Whitby on from DLUC to talk about the consultation. I'm not sure whether I'll definitely get that, but I'm hopeful that we will. So be able to talk to Jeffrey about exactly some of the thinking behind the consultation and the proposals for next year. Then we've got the autumn statement, which will be due out on the 22nd of November. So we'll be doing our normal stuff around that, briefing notes, changes to the model, etc. And then we'll do a webinar the following week on the Tuesday, the week after that. So we'll have a good chance to talk through in detail about what the autumn statement looks like and the run up to the general election and what that means for the longer term. Then we look ahead. The month after will be the provisional settlement. We know where we are with that and what that will look like, hopefully. So Dan, I think we're probably a bit shorter of time on this last section than we'd intended. There was a lot to get through to get us to here. So we'll probably skim over this quite a bit, I think. And Dan's covered quite a lot of it already. I mean, the main things that I wanted to say were that there's clearly a lot of stress coming from the sector. A lot of people reporting that Section 114s are either imminent or not that far away. The Sagoma stuff was particularly useful on that. And more advice recently from SIPFA about whether or not you issue a Section 114 notice, and basically almost, I think, saying don't need to issue one whilst you're discussing things with DLUC, because you still have, I guess, some hope that things will improve, which I think is probably a good idea. I think some authorities I spoke to recently who are not that far off from this are almost of the view that what does a Section 114 add? Does it help or does it not help? And if it doesn't help, do you really need to issue one, or do you just keep trying to make things carry on and hope for something to improve? I think part of the problem, though, is that things don't look like they're going to improve. We've had, as I mentioned, quite a few years now where our settlements have been quite a lot better. Core spending power has been increasing quite quickly. You can see here how bad things were up until 2016, but things have improved quite considerably since then. I mean, that is nowhere near having put back the cuts in funding that we had in the earlier part of the last decade, but nevertheless, settlements have been better than they were. And you see that quite clearly here, just how much better things have been, both in real terms and particularly in cash terms, but also I think in real terms. Depends how you measure inflation and increases in unit costs in that period of time. But we've just used the GDP deflator to show you, how core spending power has compared to internally kind of like public sector type inflation. And you can see there that at least even in 2023-24, we've had 3.3% real terms growth in funding. However, expenditure, and particularly on things like children's social care and adult social care, have been increasing much more quickly than that. And also things like SEND as well, so, provision for SEND, etc. That's been increasing very quickly too. So I think the issue really is more about that even though we've had reasonably good settlements for the last sort of 3 or 4 or 5 years, the pressure on service expenditure has been a lot greater than that. And I think in 23-24, we've seen the increases in budgeted service expenditure in place in things like children's social care, adult social care, just being an awful lot higher than they were even in recent years. And that's, I think, where a lot of councils will be seeing that pressure coming through in the current financial year. I'm going to issue a briefing now, I think next week, looking at some of this stuff in more detail, and if people want more of a discussion about it in a team session, I'm happy to do that. But I've just been trying to compare things like budgets with outturn, so we can see where there are any kind of pressures coming through that we see. Children's social care seems to have had a permanent national overspend. Adult social care a bit more inconsistent relationship between budget and outturn. But what we see here is looking at total service expenditure against core spending power, and as you'd expect, the two things are fairly well matched. But it's, as we've seen already, it's children's social care, it's adult social care where things are increasing a lot more quickly. And that, actually, I'm going to hand over to Dan now, because Dan's been. It's kind of, I think, Dan, it's kind of matching the forward look with what's been happening in the accounts as well.
Yeah, so that, I mean, that'll be in the slide patch you'll be able to see. All it says is that 70% have now published accounts, and actually, when I was looking on some audit committees, I can see quite a few 21, 22 accounts getting finalised. So some audit firms seem to be getting their act together. So there's some signs that backlog is clearing, but I suspect the backlog is so big that even the small signs. And there's little sign actually that those that are 2 years behind with accounts are catching up. Whilst I keep seeing 22, 23s drop published, I haven't seen a single 21, 22 set of accounts published. So I get that, as soon as you're behind, it becomes 3 times harder because you're behind, and catch up opening balances and that, not being able to sign off all of those things. If you go on to the next one, Adrian, this is something that's in our reserves model. Keep it up to date. And you might have heard me say previously that the unitaries were really struggling, but in the last 2 weeks, 3 big northern Mets have published their accounts, and they've had their earmark reserves have just cratered. Virtually halved from 200 million to less than 100 million. And actually, the Mets and the unitaries are in quite a bit of stress for me on reserves, and the unitaries, it tends to be small unitaries, not necessarily to do with funding and deprivation. It might be to do with the fact that they are small. Mets, I think, have always had quite a bad deal under this government, and I can't help but think that some of the funding things and stuff you said about Sagoma issuing their stuff, you can absolutely see it in the accounts. And when you move on to the balance sheet for the same Mets, you see things squeezing more over and above the reserves being squeezed. It's pretty grim, and it's not sustainable. That left-hand graph is not a sustainable picture. No. It means that in 5 years, on average, every Met and unitary will be out of resource. So it's not good, and therefore I think the government needs more than a 3% funding guarantee if it's to stay. And Lisa asked earlier on a question about it, and I think it suits the government to say all the 114s are one-off and to do with issues that are local and bad decisions, etc. And some of them are. Birmingham shows that. But actually, what that narrative hides a slow slide into real financial trouble for a really big number of especially upper tier authorities, but a significant amount of districts as well, I'd say.
Yeah, and to me, Dan, that starts to look a bit more systemic. That starts to look a bit more widespread. And the worry for me as well is that's 22, 23. You see those spending expenditure increases. It's 23. It's the current financial year where the bigger increases in in spending pressures are coming through. Yes, the settlement was better in 23-24 as well, but I think you can see that the growth in things like children's and adult social care will outstrip that. And I think 23-24, when you do these figures again, that's where it could be even worse than that, to be honest. And that's, I think, where the background to a lot of those statements that are coming out from people like Sagoma, some of the counties as well, that actually there's quite a systemic problem happening here.
And I think statements like that, and Brum having come out, is kind of paving the way for Section 114 not being as dirty a thing as it once was, isn't it?
Yeah.
It's now part and parcel. It's a legitimate tool more than it was. People used to say it was like career suicide to be the one that issued a 114. Feels less like that now because it like you say, it is systemic.
That's right.
And more approaching those decisions.
And then 24-25, and then particularly 25-26, the increase in funding doesn't look anywhere near as strong. That looks much harder. So I think the question for a lot of authorities will be, the figures you showed 22-23 look bad, Dan, in terms of a lot of the change in usable reserves. 23-24 is when we've got the bigger increases in spending pressures coming through. 25-26 is when I think we're looking at much less good financial settlements for the sector. So I think if you put those things together, and that's not a great news story, I think, for the sector as a whole.
Yeah, and to support Lisa's comment there again, I couldn't possibly forget districts, because I've pretty much always worked for districts, and what I think the analysis that I do shows is that districts have more reserves, but actually that things like those waste costs, as you say, that they become a massive proportion of spending power. So when before the government bailed out on the fees and charges, that if they hadn't have done that, a load of districts would have gone to the wall, because they're so geared towards income, car park income and other types of income as well. So they do have more reserve, yes, but they are more susceptible to big changes like the waste and other bits and pieces. So I wouldn't dream of forgetting the old districts.
No, we have been a little bit social care upper tier focused today, but I mean, it's we're trying to cover everything as best we can. I mean, for those of you who can't stay on for the discussion session afterwards, thanks very much for attending. We've got through all our slides now. There's quite a lot in there, but thanks for coming along. For those of you who can, just open the floor now to any questions, any comments, anything that you wanted to mention or ask more about. I think we've got quite a few things in the chat as well, haven't we, Dan?
Yeah, it's quite a few that's come through.
Yeah. Actually, top of my head, first, one thing you mentioned, Dan, about some of the benchmarks that the government have been issuing through Oflog around debt, and including the HRA debt in there as well as general fund debt, and they've been really quite misleading. Actually, some people have got to cause quite a lot of difficulty for people. I think that's quite that's much naughty. It's just unhelpful, isn't it?
It just shows a real dull ignorance on behalf of those that are responsible, because first of all, and I'm at the point, because started incorporating Oflog measures into some of our modelling, it's all wrong. The RA forms are way off beam in most authorities. And I've spoken to a number of people saying, well, we're really going to get to grips and get our RA forms right now, so that they are right. Well, that's all well and good if yours are right. There's still 160 other that won't be. And I know less about the capital returns, but that until they start looking at getting data quality right, you can't even see the wood for the trees. And then when they get the data quality right, you're absolutely right. Those with HRAs, particularly at district level, will have high debt. That they all will, but actually our capital monitoring shows that HRAs bit by bit are getting more capital healthy than those with just general funds in aggregate. So again, that's misleading. I've spoken to some members about how we might be able to provide the context around that. But it's also one-eyed on top of that. It's just debt, and a lot of people, in the chat, said about. I think you said, Chris, you're incurring debt to reduce costs. Well, that's a perfectly good reason for incurring debt if it stacks up. but you'll now get caught in the government's net as of your high debt. So they've got the 4 new mitigations. Some of them have got merit, but they don't work standing alone. The one on the obsession with investment properties continues.
Yeah.
And I don't think they've got a good way to measure that data quality wise. There's a bit of an obsession with non-PWLB stuff, which I don't know, maybe it is a thing, but it doesn't feel as big as other things to me. So again, they're going off of 4 measures that give a bit more insight, but will still drive the wrong behaviour on their part because they're using RACO returns.
They haven't got your data, Dan.
Yeah, well, yeah, they can. They can buy offers for £1 billion. It's not clever. It's not clever.
No. And I think asking about that.
Those of you that have been subject to some form of intervention by government, I don't know, but I'm guessing it is unhelpful to you if it's based upon the government's misunderstanding because their data quality is shot to pieces. So I've spoken certainly to some of our members who said actually the offlog stuff set a whole load of hairs running, that they've had to go and say no, the data's not right, and nor is the comparative data. So let's have a discussion with the correct data first. But offlog really need to get up their game, as does central government. If that's as does Sept, I'd argue, if we're going to have a proper debate about the figures. Yeah,
no, I agree with you. Stuart Hogan, I think are you still on the I think that's it. Yeah, I wanted to ask you, Stuart. Hi, Stuart.
Hello, can you hear me?
Yeah, I can hear you. Yeah, I just want to ask you about the levelling up bill. I mean, what do you think? Do you think they'll manage to get it through before? Well, I guess before the end of the year, so it's there in place for councils to do that second home premium. What do you reckon?
I mean, I think at every stage it's surprised by how long it's taken.
Yeah.
I remember, Adrian, you and I discussed whether the premium could be in for 23-24, and at the time, based on regular assumptions about the amount of time that legislation can take, we thought that was unlikely, and we guessed 24-25. But now we're at a stage where even that is something we can discuss whether it's likely or not. I mean, surely it wouldn't be delayed by a full year over the estimates we made earlier, and surely it would be ready for 25-26. But it has always taken longer than expected, and of course it must be reaching a point where they'll be struggling to complete it before the general election under an early scenario for that.
Yeah. I guess it's tied up with all the planning stuff, isn't it, and the housing stuff in there that are just so controversial.
Well, yeah, but it's not the first piece of controversial legislation. There's something to do with the management of it. I think the Hansard report showed that significant numbers of bills that were included in the programme have spilled over into the subsequent session. And whether it's to do with the management of the programme, or is it something new about the way that Parliament runs and the power of the backbenchers, that we haven't seen before. When I made my career doing feat of legislation in times past, you could be fairly sure of a high level of behaviour amongst government backbenchers. Maybe that's just not there anymore.
Yeah, and I guess general election coming up, plenty of them maybe thinking I won't be coming back. What's the point? I can dig my heels in and make it awkward.
Yeah, I think it's more what's the retail stuff that we can get in place and take credit for. It's too late now for almost any policy to deliver, but if you can announce it, and if it has kind of strong resonance and creates political differentiation between the government and the opposition, who've been moving closer together over time for some period, and the government's now making an effort to create differentiation. Those are the things that it will be focused on, and the question is whether the legislation serves that purpose, and indeed any other announcement that they might make.
Yeah. It's just it's such a lot of money for councils. That's the thing, isn't it? I mean, some people in particular. I mean, it could be the difference between a Section 114 and not a Section 114. To be honest with you, it's huge.
Yeah, but in the harsh realities, issues of financial stress and long-term planning and critical local services are probably not getting the weight in current debates that they might. That's not where the attention is at the moment. I think we can all observe that. You don't need any special insight to say.
Yeah, no, I can see what you mean. It's just this is a shame. Yeah,
it is.
Yeah. Dan, what do you reckon? I was just talking about. Just I can see if you. I think it's Chris Blundell. You think you got quite a lot of income coming through, do you, Dan? Is that what? Sorry, Chris. Is that what you're thinking?
Excuse me. Yeah, coastal authority, coastal districts, second homes is huge for us. And not just us, but the county as well. So there's been a lot of discussion across Kent around trying to remove as many of the discounts as possible that are still in place for empties, and the county offering us some incentive to do that because they're the main beneficiary of it. But obviously there's more work for the billing authority, so something perhaps for other two-tier authorities to look at. Yeah,
so that goes beyond potential for a second home premium. It's
I mean, we've been looking at what you got now. I think Class D it is for those that are got sort of properties that are looking for renovations. So that's our last sort of discount on empties that we'll be removing, subject to council approval as part of the tax base setting this year, because the county, as much as us, need anything and everything they can get their hands on in terms of the tax base.
I can imagine. Kent have been issuing some reports, haven't they, about the pressure they're under in the next year or two, and how to survive that. I mean, I think that's I guess the Kent will be looking for everything they can from.
I mean, I don't want to speak on behalf of the county. That's not really for me to do. But
no.
Yeah, it's their they're as you guys have already illustrated. Lots of upper tier authorities have got real financial stress in terms of use of reserves to close balance, sort of systemic budget gaps. So they are looking at all options to do that, and that has impacts for districts as well. So we're looking to try and work across the county, across the tiers, to try and have as joined up approach as we can, because to minimise the impact on the overall tax overall for the taxpayer.
I guess for you as well, Chris, aligned to the council tax debate, is that I'm guessing Thanet took a massive hit in 13-14 in terms of council tax support. So your tax base would have been reduced at that point. Then they already took a 10% haircut. Everybody did when tax benefit got rolled into the grant. But that CTS is in SFA and has been subsequently cut by another 60%. So some of our members that had large CTSs, you can see that their tax base hasn't even recovered back to the position of 13-14. And under the old regime, equalisation would have come in to save them to some extent. And that hasn't. And again, that impact is really marked now. If the CTB system was in still and equalisation was still in the system, resources adjustment still in the system, authorities, I'm guessing like Thanet, would be doing a heck of a lot better.
It's one I trot out quite a lot in terms of so in Kent there's 11 districts, and we've got the second highest tax base in terms of number of properties. But once you put through all the discounts for CTB and single persons, we've got the second lowest tax base. So you can see the demand that puts on us in terms of service delivery. Just we've got a number of homes just for number of bins we have to empty, let alone the demography and demographic pressures and deprivation. But we've been hammered by that, and the second homes will go some way towards closing that gap, because we've got loads of holiday homes, which then is putting pressure on us from temporary accommodation perspective as well, because it's reduced the supply of housing in the private rented sector as well. So it's a bit of a perfect storm.
Helps you. There's quite a few comments here and there about the pressures on districts, and I do feel that we haven't looked at we've kind of not given them their due focus today, which I apologise. We'll do better in our briefings and other stuff later on.
And there's a danger, isn't there, Adrian, with that? Because if you do look at reserves, and again, that's where you say it's more than just reserves. District reserves on aggregate have gone up, and I get that because they haven't reset the business rates base, and at the higher end, there's lots of districts just pocketing into reserves a load of business rates gain, which means the aggregate goes up. But that hides some districts that are really struggling as well. Yeah. And as we said earlier, the districts are more susceptible to big moves. So all the waste stuff will be a massive part of districts' budget. But I think there's a danger, and I think we've seen in the last few years, that social care predominates in the settlement argument, and all the district will get is the 3% funding guarantee, and even then there'll be a sleight of hand. So all this extra money that was supposed to be coming in for producer responsibility will be used to fund the 3% guarantee, whereas when it was first touted, it was, well, it's lots of extra money for you, but it won't be. It'll come in and all those guarantees will disappear, and new homes bonus will disappear, and all the things that are generous to districts will disappear. So I think because the districts aren't the ones showing up with the problems in the same magnitude as the upper tiers, I think the government will make district unfriendly decisions in the next settlement. That's my
risk of that. Yeah, Lisa, you're going to make a point.
Yeah, that's right. I think the proportionality argument is the one that's missed for us little districts, which and obviously we're nowhere near the scale of counties. I'm not trying to obviously undermine the scale of the pressures that they're under, but it does kind of hide us. And I think the narrative in last year's settlement was totally ignored us, didn't it? It said that, and the headlines were the funding staying the same, and then that's another argument we've got to have with our members, that it hasn't stayed the same for us. There's no mention of no homes bonus. There's nothing on the funding guarantee. There's nothing on, there's even less certainty for us on the back of last year's settlement than there has been before, I think. And it's just it's almost impossible to try and plan. Like, do we assume it's all coming out? That's another nearly £2 million for us, which if that's all that counties were losing, they'd be laughing. But I just think that the pressure is proportionate across all of us, and we can't compare ourselves directly, but we just need it all considered in the round.
Yeah, I mean things like, I'm saying, we know a lot about what's going to be in the settlement next year, and we do, but we don't know what's happening to new homes bonus, and for districts that is such a big issue, isn't it? It's huge. And I mean, we may not know about that until the settlement itself. I mean, we're getting pretty close.
Yeah, I mean, if that goes, we're in massive trouble.
Yeah.
But and as I said, the business rates for us is huge, but I can't build that into my base budget if I'm going to lose another £6 million again. That would just bankrupt us, obviously.
Yeah. Yeah, and that is a big issue. I think you mentioned that in the comments, actually, Lisa, about having certainty over the business rate reset would really help. I mean, it's great that if you're an authority with growth, especially district, it's relatively a lot of money, which is what's driving up the average amount of usable reserves for districts. But it's double-edged in that at some point it's just going to go, and the impact of that could be will be huge. I don't know.
We don't even know what the reset means. So it's like, are we banking? Are we planning to lose all of that money? Or can we keep any of it? If we lose all of it, I'm just might as well hang my coat up now. So
hand the keys back.
Switch the lights off. Well, they won't be running because I can't afford the bill.
Yeah. Jeff Garfield, were you there, Jeff? Did you put your hand up? Yeah, that's it, Jeff.
Yeah, thanks, Adrian. Yeah, sorry guys, I'm in the middle of moving office, so you've been on the background, so I've been hearing some of what you were saying. And apologies if you've covered this issue. We had a discussion as 12 North East authorities with Nico Hislop a week and a half ago.
Oh yeah.
And one of the things that we pressed him on the settlement, and he very helpfully said, we're very hopeful you might get it just before Christmas. So no surprise there. Nico did say that there will be a policy statement again this year, the same as there was last year. So you may recall a couple of weeks or maybe a week before the settlement, we received a policy statement, which gave us some high-level indication what was coming. We did press Nico to say, well, when would that be coming out? And yet he wasn't forthcoming in saying when it will be coming out. I think that would be very useful, Adrian, if we could find out when that's coming out. Even if it's bad news, at least we'll know. And our chief exec was having a discussion with Mark Lloyd yesterday. And Mark wasn't hopeful in any shape or form of any additional funding coming our way next year above what we already think we're going to get, which is pretty disastrous, isn't it?
Yeah, it is. I mean, in terms of the timing, I'm guessing, Jeff, that if we've got the autumn, and actually Stuart, you may be able to give us a bit of a point on this. If the autumn statement's not till the 22nd of November, I'm guessing the department would need at least a couple of weeks to prepare the settlement after that. So I mean, we're not looking at things being any earlier than we've had for years now, Stuart.
No, I think that's right, especially if there's any changes in the autumn statement for any of the material. It takes at least 2 weeks to be comfortably sure about the quality assurance of, what's, I think, of the order of 250,000 numbers. So I would not expect it to be significantly earlier than in previous years. I don't think Nico's statement tells us a great deal, because if it does slip till after Christmas, then the timetable is worryingly compressed for the process itself, as well as, of course, the local authorities that are engaged in the process. So they will do everything they can to get it out before Christmas, which in effect means that the days of the Christmas period count towards the length of the consultation period. That's where the time saving is made. So it's kind of externalizing the pressure from the department onto authorities in terms of responding to the consultation, but more meaningfully revising your budgets if necessary to take account of the actual numbers. So I think not much earlier than in previous years, which in effect means the last week of the parliamentary session. Have a look at the Parliament website and see when that is. It probably won't be on the last day, but it could be the second last day. That would be my guess, sometime that week.
Already checked that, Adrian. It's the 19th or the 20th of December. So yeah, in line with what Stuart said, that's what we're expecting. And one of the things which we did press Nico on was new homes bonus. And he gave us strong indication, as I've had previously, that there will be one more year of the new homes bonus.
Yeah,
I think his viewpoint generally was, if it was going to go, there probably would have been a consultation of some nature out by now.
Yeah, I think that's right. There's been a number of consultation on this, but they don't provide a clear direction. And the tendency in government is to avoid any big fights or undue turbulence at this stage. Their attentions are elsewhere, as I mentioned earlier. So why pick a fight by getting rid of this? And there isn't a kind of coherent policy in terms of housing incentives and what you might want to do instead, or as an alternative with the money. So the easiest course is just to have another year. And the reason he says a year, of course, is that gets us beyond the election, and it simply means that a new set of ministers can take a view on the way forward. So that would be my central bet, that we will see another year. The ground just hasn't been prepared for a shock of this magnitude, and it's really not worth the candle to pick a fight with so many authorities at this point in the political cycle.
Yeah,
but I don't understand the argument. If they scrap new homes bonus this year rather than another year, it would just come back as funding guarantee. So no one would lose, because the funding guarantee, what they'd lose in new homes bonus would be replaced. And if you look at last year, there's an equal £1 relationship between dropping new homes bonus when it went from 2 to 1 years and funding guarantee. Funding guarantee just filled the gap. So for me, I think the argument new homes bonus has been lost by local government already. When it went from 6 to 4 to 2 to 1, 3 to 2 to 1, whatever it went to, it's a dead grant walking, and it's almost semantics as to whether it's there next year. Because if it isn't, funding guarantee will just what they save in new homes bonus will spend on funding guarantee.
There is an interesting thing, though, Dan, with new homes bonus for next year. There'll be a bit of redistributive impact, because lots of deprived areas have got no tax base growth, much more than would have been the case previously. So if affluent areas do have tax base growth and deprived don't, you might see a bit of a flick. So I know, for an example, we've always done pretty well out of new homes bonus, but we won't hit the 0.4% barrier for this time around. And I think a lot of council, I think it'll be interesting to see. The government might not be able to use all of the funding that's in there. It's about 250, 300 million left, or whatever it is. It wouldn't surprise me if all of it wasn't used. So we'll have to make sure that if it isn't all used, it doesn't disappear somewhere.
Yeah. I guess if it isn't, Jeff, it'll just get rolled into something like the services grant or something like that. But
oh no, we don't want to go on there. We want to go into the social care grant, Adrian. Come on.
I have no opinion.
I'm not sure you'll have many districts agreeing with you there, Jeff.
They've had the benefit for years of the new homes bonus, Dan. I've got no sympathy.
Yeah, that is precisely the point, is that, I mean, you're right, Dan, it is a dead grant walking, that's a lovely phrase, but it's, the status quo is always easier to defend than making any change. You know, just let the zombie walk on for another year.
I'm happy with one more year of new homes bonus, because we've had that in our model for a while, so we've kind of assumed there'll be one more year, 24-25. So I'll be happy to be to get that, to have got that one right. I'm okay with that. But Martin Mitchell, that's a nice comment. That well, first point, the police settlement's been issued a few days earlier recently, which has been handy. When his mayor was local government minister back in 2009-10, just weeks after the Lehman Brothers collapse, a 3-year provisional settlement was published on the 25th of November. Remember those days? That was the good old days when we got the settlement way before the Christmas break started and we could get everything done before the Christmas parties began. But not anymore. I think you're right, Jeff. I think I'm looking for the day before the last day of the session. Looks the most likely. And actually, what I've been doing recently is just keeping a log of when the provisional settlement's been announced for the last 10-12 years, and actually the trend's been pretty much stuck for about 7 or 8 years now.
It's never gone over. It's never been after Christmas, has it?
No, it hasn't. No.
Well, I think it was 1 year when there was a particular emergency situation. I seem to remember. I can't remember what it was. Probably something to do with Brexit.
Even that, Stuart. I think even then, I think it's always been before Christmas. It got very late. I think it might have been the last day of the session on one year, 21st of December, I think even. But yeah,
you're probably right.
Adrian, just add one other thing, Adrian, before I need to jump off. The other most important decision that will get us local government, particularly for upper tier authorities and single tier authorities, will be also on the 22nd of November, because the Low Pay Commission always announced the national living wage increase on the same day as the autumn statement. The Low Pay Commission came out in March with a revised position saying national living wage will go up by 7% next year. That was their forecast. However, since then, the national median wages have gone up significantly.
Yeah.
And as you're probably aware, national living wage is supposed to lift next year to hit 66% of national median wage. To get there, based upon our calculations, would need a 10% increase in national living wage. Now, that has a dual impact. Number one, everyone's care fees are mainly linked to national living wage. So you're broadly saying a 10% increase close to on your care fees, which would bankrupt most upper tier authorities, just about.
Yeah.
Secondly, however, our employers' organisation are terrified of the national living wage. The last 2 years when we've had the 1925 flat rate increase in pay has been to accelerate our lower grades away from the national living wage. So if the figure for this year, the 1925, was based upon a forecast of a 7% increase in national living wage next year, if it goes to 10, chances are our employers' organisation will go for a flat rate uplift on pay in local government again next year. I had 2% in from pay next year. I've now lifted it to 4%. And I'm basing my national living wage forecast now on 10%. So from a lobbying viewpoint, working with Sagoma and others, we're pushing heavily on the government not to increase national living wage and to hit the target for national median wage of 2024. We're asking them to defer it for a couple of years, even if it goes up in line with benefits, which will be the September CPI at around 6.5%.
Yeah.
Will be great news. But if national living wage goes up by 10% next year, then we are goosed. That will be the final straw.
Yeah, I can see that. And I mean, some of the numbers that I've had in the presentation today, Jeff, I've kind of used the GDP deflator as a measure of kind of price inflation within the public sector. It's not quite that, but it's sort of that does that kind of thing. So obviously that's why we've kind of had shown real terms increase in core spending power in 23-24. But I guess what you're saying, that if some of those those inflation pressures are still kind of coming through, or coming through even stronger into the wages that local authorities are paying, both internally and kind of like to providers, then actually our internal inflation measure within local government is going to be higher than I've got in those numbers. It's going to be higher than it's been in 23-24 in that case, isn't it?
Well, it would be a very bizarre decision, I think, if government agrees to increase national living wage by 10%, because it would go up from next April. And when the Prime Minister met with all the supermarkets in May this year and asked them, why are you putting up your prices so much? Are you taking super profits?
Yeah.
And the supermarket said, actually, Prime Minister, it's because you just increased national living wage by 10% from the 1st of April. So if the government were to increase it by 10%, the impact on CPI next year will be significant. It would flick back up again, which could be just before an election in October. So we're still praying for an election in October on the national living wage, but also then praying for a election in May, so we can have a comprehensive spending review in the autumn, so we can get a long-term settlement. So I'm not quite sure which one I want the most.
Yeah. No, I know what you mean. It'd be nice to get it all over and done with and know for sure. But I mean, I can see with the national living wage that actually the current Chancellor, everything for him is going to be aligned around making sure that inflation is in check and hits the Prime Minister's target of halving it by whenever he's going to halve it by. Hopefully that.
If inflation averages 3% next year, and national living wage goes up by 5 or 6%, that's pretty good.
Yeah.
If it goes up by 10%, most county councils, upper tier authorities are pretty much polished.
So it's a really good point. That's a really good point, Jeff. Thanks for that. That's great. Thanks for everyone for coming along today. It's been really useful. Thanks for Dan for that really fantastic presentation, and make sure that you get along to his webinar on the 10th of October, and then we'll certainly do one towards the end of October on our stuff. And a few people have said they're interested in some of the analysis we've done around section 114s and that sort of thing. So we'll put a briefing note out hopefully next week, and if you want, we'll do an extra session as well. But for now, thanks for everything. Thanks for coming along. Thanks for listening. Thanks for contributing, and we'll see you all soon. Thank you. Cheers.